Hi guys. Today we will analyze Goodyear tire stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock's overall performance in the market is below average. The short-term trend is positive, while the long-term trend is still negative. There are some positive events in recent action. It is advised to wait a little bit longer to see how this turns out. Strong support level is around $11. Next strong support level is around $8. Strong resistance levels are around $13.20 and $14. Next strong resistance levels are around $16 and $19.50. In the last month the stock has been trading between $10.50 and $13.50 range. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 3.9 million. This is a good sign as it is always nice to have a liquid stock. The stock has been in a downward trend since January 2022. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth. Even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 4% per year, for last 5 years. We see that the average profit margin of the stock has been around 0% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 35% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Goodyear Tire Company: bad, average, and good. First scenario. Goodyear Tire will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 2%. Future profit margin would be low, 2%. Future free cash flow to net income rate would be low, 20%. In this case, the fair value of the stock today would be $5. Second scenario. Goodyear Tire will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 3%. Future profit margin would be average, 3%. Future free cash flow to net income rate would be average, 30%. In this case, the fair value of the stock today would be $12. Third scenario. Goodyear Tire will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 4%. Future profit margin would be high, 4%. Future free cash flow to net income rate would be high, 40%. In this case, the fair value of the stock today would be $21. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 3.34. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Goodyear Tire, analysts forecast growth rate around 5% per year in next 5 years, and future P/E around 7. Again, I will use 3 different scenarios for Goodyear Tire Company: bad, average, and good. First scenario. Goodyear Tire will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 2%. Future P/E would be low, 5. In this case, the fair value of the stock today would be $8. Second scenario. Goodyear Tire will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 3%. Future PE would be average, 6. In this case, the fair value of the stock today would be $11. Third scenario. Goodyear Tire will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 4%. Future PE would be high, 7. In this case, the fair value of the stock today would be $14. As you can see, today the stock is fairly valued, $13, if we expect the company's high performance in future. While the company has a medium profitability rating, there are some concerns on its financial health. Also, the stock is expected to show a small growth in revenue in the next 5 years, 5% yearly. However, the stock looks fairly priced at the moment. Keep in mind that the stock has been in a downward trend since January 2022, and it can go lower, before it recovers. The stock's current low valuation adequately reflects the company's near-term challenges. It's a good buy, if you believe that Goodyear can manage its debt, and improve its revenue and profit margins. Do your due diligence, before buying the stock. Company's strengths. Goodyear Tire and Rubber Company is an American multinational tire manufacturing company based in Ohio. It manufactures tires for automobiles and trucks, motorcycles and race cars, airplanes, bicycles, farm equipment and heavy earth-moving machinery. It also manufactures and markets rubber-related chemicals. Goodyear is one of the top 4 tire manufacturers, along with Bridgestone, Michelin, and Continental. Goodyear's sales are well diversified across the world, with North and South America representing the company's largest market. Goodyear continues its history as an innovator and industry leader. The company has significant growth prospects, despite ongoing risks. Goodyear has raised prices, added new suppliers, and lowered distribution costs to help offset the impact of inflation. It should also benefit from continued growth in the electric vehicle market, and from its recent acquisition of Cooper Tire. The company's return on equity of 16% is amongst the best returns of the industry. Its return on assets of 4% and profit margin of 4.5% are in line with the rest of the industry. Risks. The pandemic and subsequent lockdowns were nightmares for tire companies, and Goodyear has suffered a huge drop in price as a result. Goodyear's stock has underperformed, as the company has struggled to increase revenue and profit margins. Margins will likely suffer from higher crude oil prices. 2/3 of Goodyear's raw materials costs are crude oil-based, and it doesn't hedge. Goodyear shares have fallen recently on concerns about rising costs, and supply chain disruptions in the auto industry. Management said that it expected cost pressures to persist over the next several quarters. Goodyear has a $2.1 billion share repurchase authorization. It did not repurchase any stock in 2020 or 2021, and we do not expect it to resume repurchases this year. The company has also suspended its dividend. The industry is very cyclical with intense competition, and it suffers from global overcapacity that creates pricing pressure, and makes it difficult to earn high economic profits for all participants. Goodyear has had a very volatile and inconsistent earning and free cash flow recently. Also, the company has a high debt level. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow by 5% on average per year. The earnings per share is expected to grow by 10% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.